You'd be hard-pressed to find housing economists proclaiming that the ongoing housing boom is nearing a 2008 type style bust. In fact, many say the opposite based on the belief that people see the value of real estate over the stock market, the uptick in purchases of vacation homes, people are parking their money, and the demographic wave of millennial first-time buyers are still out there, elevated wage growth, and the overall limited supply. Yes, inflation has added a wrinkle to the mix. Will all continue pushing the housing market upwards. Every major real estate firm with publicly available forecasts, including CoreLogic, Fannie Mae, predicts the home prices will go even higher over the coming years. So it's not just how high prices have become, it's how fast it got there, folks. You are seeing some softening in the market, longer days on market, price reductions. It's important to look at the markets locally, not holistically. Things will be different, for example, in Studio City, California, compared to Henderson, Nevada. So with demand now shifting towards renting, home builders who were once reluctant to sell to rental investors are now soliciting offers from investors. I'm hearing this on my investor group Zoom calls, so I knew this was coming. So the point I want to make is strong demand from investors will provide additional support to today's home prices, investors and the institutional investors. So the housing market hits a level not seen since the last bubble. It only took 24 months for U.S. home prices to soar to a staggering 37.2%. For comparison, the biggest two-year spike leading into 2008 housing crash was about 29%. That is absolutely incredible. Higher mortgage rates are the best thing, in my opinion, for housing because we are in an unhealthy housing market and we need to get off these, extremely, extremely low levels of inventory. So when we get into the summer here, the Federal Reserve decided for the peak season of the summer, it had seen enough. It was transitory for a year and a half. The central bank quickly raised interest rates, which saw the average 30-year fixed mortgage rate climb to over 6% from 3.2% at the start of the year. So those higher rates, which have priced out many first-time shoppers, ultimately ended the pandemic housing boom. Now we're in a sharp slowdown, with the Mortgage Bankers Association reporting on Wednesday that mortgage applications are down roughly 16.2% on a year-over-year basis. So, as this shift occurred, we heard very little from the Fed. And, until Chair Jerome Powell addressed reporters on Wednesday, he had a few things to say. And I'll just paraphrase what he said. Powell, he said we saw home prices moving up very, very strongly over the last couple of years, and rates have moved up. So we are aware of the mortgage rates have moved up, and he's just playing both sides of the fence. He's basically saying we're seeing a changing housing market right now. We're going to continue to watch what happens. He's saying that he doesn't know how much it's going to affect residential real estate investment, and he's not really sure. Obviously, he says we're watching it. The key takeaway from what he said, though, is it's still a very tight market. So he says prices might keep going up for a while, even a world where rates are up. So he says it's a complicated situation. He's going to be watching it very closely. So if you're a home buyer right now, or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down to low levels again and mortgage rates are low again. But there's a lot of investor groups out there buying up real estate. So I think some things that stand out from the readings, the Jerome Powell and what the Fed said, is not 4 points. Powell thinks home buyers need somewhat of a reset out there. It's just a question of how much. In the housing industry, the total number of active listings is referred to as inventory. So since 2014, annual inventory levels have been declining. That was driven partly by shifting household preferences. For example, staying put longer, lower levels of home building following the 2008 housing crash and the onset of the millennial first-time home buying. But once the pandemic housing boom took off, inventory levels began to nosedive. By spring 2021, inventory hit a 40-year low. That has given homebuyers little choice but to bid up and over asking on home prices. So I think it's clear that Powell hopes the housing cool down caused by the rising mortgage rates will help to push inventory levels up. Powell suggests it'll help buyers. The thinking being when shoppers reset their housing hunt, they'll be met with a friendlier market. So higher inventory levels would, give buyers some more time to decide and reduce the chance they'll have to engage in a bidding war. But like I said, you break this down right now, you're getting 6 to 8 bids, and you're still getting 4 to 5 bids right now in the markets that I'm looking at. So according to the National Association of Realtors, U.S. housing inventory inched up, 1.03 million heading into May. But to get back to a normal, folks, normal housing market, inventory would need to rise to 1.52 million to 1.93 million housing units. Inventory levels nationwide, they're rising fast, but they were at a low base. However, over half of regional housing markets still have inventory levels 50% below, 50% below pre-pandemic levels. So bottom line is, we need balance. We need balance in this market. The housing market is still unhealthy because total inventory levels in America are still below the 1.52 million. So we got to keep an eye on that. Number two, falling home prices. Powell seems to have suggested it's possible. It's possible. Fed Chair Powell raised a hypothesis that home price drops could happen. How much will it affect home prices? He's not really sure overall, and he's just going to keep an eye on it. So there is a tremendous amount of supply in the housing market of unfinished homes right now, and they haven't come online yet. So I think he's pivoted and said, whereas the supply of finished homes, inventory of finished homes for sale is incredibly low, historically low, it's still a very tight market. And prices, if you read between the lines, prices might keep going up for a while, even in a world, folks, where rates are up. So it's a complicated situation. And he needs to keep in mind, and he's got his investor group friends, BlackRock, that are buying homes, and investors, smaller investors, see the value of real estate. So for a moment, it sounded like Powell was about to say home prices would fall, but he didn't say that. He didn't say that. Historically speaking, outside of the Great Depression and after the housing crash of the 2000s, year over year, home prices declines almost never happen. Never happened, folks. But today's circumstances could lead us into a rare period in which home prices do indeed fall. Powell once said, it's telling that Powell didn't close the door on the possibility of home price declines, and instead said, we're watching it quite carefully. I like to quote, last month, Moody Analytics chief economist Mark Zandi told Fortune that spiked mortgage rates have pushed us into somewhat of a housing correction in the near future. He expects year-over-year home price growth to decline, 20.6 down to less than 5% in significantly overvalued housing markets. You can't look at this nationally. He expects 5 to 10% home price declines. And if a recession does come, Moody Analytics said it expects a 5% decline in U.S. home prices and a 15 to 20% decline in significantly overvalued housing markets. Overvalued. You have to look at that. So look at how high they went up in 2 years. Okay, you have to look at where the investors are going in overvalued housing markets, because it's not going to be the same everywhere. I talk to people, and you have to educate your clients, and everyone thinks, oh, it's nationally. You have to look at what the overvalued markets and where you expect price reductions. So why are home prices now susceptible to decline? It starts with the fact that home prices have become, detached from the underlying economic fundamentals. Basic economic theory teaches us that home price growth and income growth are somewhat interwoven, and neither can outrun the other for long. That affordability crunch has only been worsened by soaring mortgage rates. In fact, over the last 6 months, the typical new mortgage payment has spiked 52%. So home prices can fall, however, but for it to happen, inventory will likely need to rise a lot higher. Once U.S. inventory levels, in my opinion, climb over 2 million units, home prices could begin to fall nationally on a year-over-year basis. So where do you think home prices are going to be in 20 years? There's only so much dirt. So if the Fed's over tightening causes a recession, inventory could reach levels that allow home prices to fall. So it's looking increasingly likely that we're approaching kind of a sharp inflection point in the markets right now. Everything that's going on because of the energy production that we shut down the U.S. economy. Number three, Powell explicitly said he'd like to see mortgage rates fall. So he ended with that. So the central bank raised interest rates to both halt the pandemic housing boom and to rein in the runaway inflation. So once the Fed has inflation back under control, don't hold your breath. Elevated mortgage rates could begin to recede. So we'll have to keep an eye on that. But number four, for me, you have to look at the markets regionally, not nationally. And you have to look at these overinflated markets. For example, the number one overinflated market in the country is Boise, Idaho. So home shoppers eager for mortgage rate relief might be waiting for a long while. As of last week, the consumer price index was at 8.6%. The Fed won't let up on inflation fighting until the CPI returns to 2%. On Thursday, the Fed made it clear that the fight could last well into 2024. We know that 8.6 number, folks, is over 18%. It's just to make you feel good, So bottom line is there's a lot of people with money out there that still see the value in real estate, and Powell would not come out and say the prices are going to drop, but that they're keeping an eye on it. So we'll have to keep an eye on that. Just want to recap what the Fed had to say. Have a great week, everyone. Take care.